we talked about the increase in energy prices during March and the impact that increase might have on the overall economy. We started to see some of that impact, at least in the data, over the course of the past month, most notably in the Consumer Price Index and the CPI. So let's take a look at our first chart here and look at the impact of a higher inflation rate and what that might mean for consumer spending going forward. So here we're looking at the spread between the yearly change in average hourly earnings, or the yearly change in wages, and the yearly inflation rate. So this is a measure of real wage growth or a measure of consumer buying power. When this number is rising, consumer buying power is rising. Wages are outpacing inflation. When this number is falling, when this number is in negative territory, consumer buying power is falling. Wages are falling short of the inflation rate. You can see for much of the last several years, wage growth has outpaced the inflation rate. We've had stronger average hourly earnings growth than consumer price index inflation growth, consumer price index growth. But last month, we had the big increase in the CPI. The consumer price index was up by 0.9% for the month. That was for March. That takes the inflation rate to 3.3%. Wage growth has slowed to 3.5%. That's the lowest in almost 4 years. And so now there's a very small gap between wage growth, average hourly earnings growth, and the inflation rate. So consumer buying power is diminishing. This is the risk going forward. If energy prices were to stay elevated, if they were to continue to rise from here, it's going to put more pressure on real wage growth and in turn put pressure on consumer buying power.
To watch this month's complete analysis and receive daily updates directly to your inbox, become a member at cycleframework.com.